Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome in to the weekend edition of the KE Report. Thanks for tuning in on this weekend show. We're going to be covering some of the moves in the commodities. Still very strong commodities prices out there. Look at some of the ETFs for the underlying commodities stocks. And in the back half of the show, talk more energy sector news, even though we still have oil, natural gas very much stuck in ranges. Just as a reminder, please go back through our website, kereport.com. Podcast, search the KE Report in your podcast player to listen to all of our daily editorials and all the company updates we are recording and posting throughout the week. To kick off this show, we're bringing on Rick Bensignor, president of Bensignor Investment Strategies. He writes the institutional newsletter, Supposedly Irrelevant Factors. That is read by some of the most successful hedge funds in the world. And on the retail individual side, check out In the No Trader, that website. I will post a link in the show notes to that website. Rick has 3 products. The 7-Eleven Ultra, that's where he's constructing a portfolio like a hedge fund would build. He also writes the weekly report, Tactical Trader, and a daily report called the Daily Tip Sheet. Rick, as I said, I want to focus a bit more on some of the commodities moves. Let's start off with one of the more widely followed commodities, that being gold. Gold is right around that $27.50 level. It's a strong gold price, and that's even in the face of the higher dollar this month, higher interest rates. Take us through your outlook for the gold market, please, Rick.
So I have trimmed some gold up here at about $2,700 that I've had for years. I've had some long-term targets up here on monthly charts, quarterly charts, and enough so that to me, I don't have to sell the top. To me, it makes sense taking some off. The dollar has strengthened too from 100 to 104 in the last months. And obviously, gold still managed to make all-time highs. But if the dollar keeps going, you got to think sooner or later it's going to take its toll on gold. And I'm not looking for a major decline in gold, but I do think that it is quite loved now. And even if I look at a particular pattern of price bars on a super long-term chart, so I'm going to pull up, let's say, a COMEX quarterly gold chart and go back to when it first started trading in the early 1970s. There's a pattern by which if you have 9 quarters in a row that the closing price on the last day of the quarter is above the closing price from 4 quarters prior, and you do that 9 times in a row, and this is part of Tom DeMark's sequential model, you actually have had the 2 times this has shown up in the entire trading history of gold, both were tops for years. Now, we are currently in the 8th of 9th bars. This is October. So this quarter runs through December, which means we don't get the 9th bar until the first quarter next year. Nonetheless, being that 2716 was a target that's been in place since December of 2015, it's 10 years later, back on that low when gold got down to, I don't know, what was it, $1,000 somewhere around there. One of these models predicted gold would get to 2716. The fact that we've gotten there this quarter, the fact that we're on the 8th of 9th bars, it's enough for me to trim. Even if you take a basic RSI chart, you're in overbought territory, even on a quarterly basis. This would be the 3rd highest reading ever, which of course makes sense considering you're on all-time highs. But I've told my clients I've, taken some profits in gold. And look, I hope I'm wrong. I hope gold goes to $3,000 because I still have a decent position. But I have definitely trimmed, and I am how shall I say, not in any way, shape, or form angry at myself that, gold's near 2750 and I sold $50 ago. Considering where I put these on, it's fine. So in the scheme of things, I think it makes sense to trim some. I am not buying gold at 2750. I am selling gold up here.
Well, Rick, let's also pivot over to the gold stocks because it's a little different chart, a little different setup. Some people believe still have some catching up to do to where the gold price even is. Although as we record this today on Thursday, the 24th, everybody was expecting margin expansion, and Newmont has kind of got crushed today, down over 14%. Not a good thing for the GDX, not a good thing for the biggest gold miner. So what do you make of the gold miners with these gold prices?
Well, look, the catch-up trade is something that people have been talking about for a long, long time, and yet it hasn't really happened. So if I just, as we're talking, I'm going to pull up a chart of GDX divided by GLD. So this is basically sideways for a couple of years in a fairly tight trading range, maybe 15, 20%, from top to bottom over the last few years. And it's kind of in the middle. So I understand the thought process, and you see a lot of talking heads on business television networks talking about the catch-up trade. So far, it's been fairly dead money. It has worked. If you put it on in the first quarter this year, we're higher than that. But if you put it on a year ago, you're barely up. If you put it on 2 years ago, you're slightly down. So, this has done nothing over time. It's really a question of, will this ultimately play catch up, considering the stocks seem to be quite undervalued? If you put the trade on, I think you have to be prepared to potentially wait years, and maybe it would come faster than that, but there's nothing that I'm looking at that is blaringly saying you've got to have that trade on from right here, right now. Generally, over the course of the year, it moves up and down enough so that, being that a week or two ago was probably the peak for this year, I'd say you probably could hold off. And only if the ratio gets above 0.17 and stays above there, but then I say it has a better chance to move higher. But right now that ratio is about 0.1666 or so, meaning the price of the GDX is 16.66% to the price of GLD. And that's how you properly trade pair trades, is by making a ratio of them. Your return is based upon the movement in the ratio. And for those who have never put on a pair trade, I will remind you, as I do all my retail-oriented clients, every time I put on a pair trade, is that you decide how much money you want to go long, whatever is going to be the numerator, whichever stock of, whichever of the two names you're going to go long. You pick a certain amount of dollar amount. Let's just pick a number. You buy $5,000 worth of, in this case, GDX. You would then sell $5,000 worth of GLD. You do not do the same amount of shares. You do the same amount of notional dollar amount. And that way you have an equal pair trade that you've bought and sold the same amount. And your return is simply the difference over time of what that ratio is that you create by A divided by B.
Interesting. Rick, I want you to put on your trader's hat from back in the day when you were a commodities trader to discuss this environment that we have here where, look, usually these gold stocks provide that leverage to the gold price, and that's why investors go into the gold stocks. Yes, Newmont's earnings disappointed the market. That being said, the stock was already up over 40% just in that quarter. So the market was pricing in some solid earnings, which clearly they disappointed the market. But with all these other products out here, these leveraged ETFs to the underlying gold price, do you think traders have a different strategy now when they're trading some of these commodities, that they're simply not going down into the underlying equities?
I think it's much easier for people to think in terms of gold than gold stocks. Because when you do gold stocks, you've got to look more into the company in itself. There's lots of names out there to choose from. Which one do you choose? Did you pick the right one? What happens if you were long Newmont? That was the wrong one. I think because the price of gold is always shown, and Since GLD has been trading for years now and is a frequently mentioned ETF, and certainly the most liquid of the gold ones, I think more people likely, if they're bullish gold, have an easy way to trade that through GLD or a similar type of, you want a fairly liquid ETF as compared to picking the gold stocks. Now, to also comment on something you've said, where you said that gold stocks, typically do better than the bullion, in 10 years, they have not at all. GDX is completely sideways for 10 years versus GLD. And from 2011 to 2015, they got crushed versus GLD. So there is no historical precedent that gold stocks do better than gold. If anything, it's the other way around. Bullion does better than gold stocks. Now, maybe with a long-term double bottom in place of that ratio, which you have from 2015 and now 2024, at a very similar ratio price, you could take the chance to buy GDX versus GLD.
All right, Rick. Well, we'd be remiss if we didn't pivot over to silver, gold's scrappy little brother, part precious, part industrial. It's had a hard time breaking above resistance at 32.50. Finally, that happened earlier in the week. We saw it bounce from 33 to 34 to 35. It's reversed down now some, but still holding above 33. That tends to that metal gets more animal spirits going in both the gold and the silver stocks. I'm curious your read on silver, where it is here and now.
Okay, so I've owned, and it's kind of been unfortunate, I've owned a position in silver for probably close to 15 years. And a few times I had a chance to make about maybe a max of 10% on it, because I'm long SLV, if I recall, in the 24 handle. And right now, SLV, which is kind of comparable to GLD, but it's for silver, SLV is trading about 30 and a half or so. So I'm finally making some money on it. I've trimmed some gold stocks also. I haven't trimmed my silver yet, partly because having traded a short amount of time, but in my years on the floor of the Commodities Exchange, I did spend some time in COMEX trading both gold and silver. It is, let's put it this way, it has a higher beta than gold. And when it moves, it can really move. It's not nearly as dense a market as gold is, and it tends to have more niche players in it. So I'm hoping that, as one particular target I can look at for SLV, it's about 33 and a quarter, 33 and a half. That's based on the 2022 low and the projection of how high it would go from there. Look, we know that silver all-time high in the metal was $50, and that was in 1980 when the Hunt brothers tried to corner the market. In 2011, I think it got to $40-ish, something like that, and then fell again all the way down to near 10. It's the thing with silver is there's always ample supply as the industrial demand pulled back over time when technology came about such that we could take digital pictures. We didn't need film in our cameras, and silver was a major component in the production of film. So, there was a huge pullback in need industrially for silver. It's not only gold's poor man's younger brother, kid brother, but think about this. If the price of silver right now is 33, let's call it $34, and the all-time high is 50, you're, what is that, 34% off the all-time high, whereas gold has made numerous all-time highs and has gotten way above that 1980 price of, what was it, $850 back in 1980. I mean, you're talking about something that is just a minor game compared to what gold has been. And it was a lot easier for a lot of people to afford to play and own silver because it was so much cheaper. But your return in silver since, I don't pick a time, here, since 2011, silver actually got to $50 or close to it, for the second time. So 1980 and 2011, long-term double top near $50. So at $34, you're $17 down. All right, that's your 34% down if you had bought silver in 2011. If you bought gold in 2011, you paid at its peak price $1,900. It's now $2,750-ish, right? So let's pull out $2,750 divided by 1,900. You're at 44% versus being down 34% owning silver, which is the right one to own. Obviously, gold has been, and it's hard to make the case that, again, silver might have some type of catch-up trade, but people want gold. They don't want silver.
Oh, that's what the market has sure been telling us, hasn't it? Let's move on to another commodity here, copper. Copper has been actually quite volatile this year. It was under $4. It was the whole way down to about $3.60 earlier this year, and then ran the whole way up to over $5, and then dropped below $4, and now has rebounded to, let's just broadly say, somewhere in the $4.30 range. Rick, what's going on with copper here? It's not usually this volatile, and what direction is it heading in your eyes?
So I have specifically commented to my clients that I want nothing to do with copper, and I'll tell you why. It moves so much on the basis of what people think China's needs are, right? And then recently we had the bounce, copper bounced from $4, got to, I don't know, about $4.65, something like that, pulled back to the $4.40-ish or so that it is now. The problem is China doesn't need any copper right now. China has cities built, many of them, without a single person living in these cities. Their construction needs for copper are done for years and years. So I don't believe the whole idea that when China rallied, when did it come? I don't know, almost a month ago, something like that, when China just flew on Bank of China easing, copper all of a sudden got a big rally. But it's pulled back also because there really isn't the demand for it. And I just think there are other metals to trade if you want to trade metals. Copper's not the one. I have mixed as much as you're starting to get higher highs and higher lows. I also have upside exhaustion signals in place from 5-6 weeks ago, 1 week before that top was made at $5. It's just something that I think you have no edge in trading. So unless you're in the copper industry and you have some, and when I say inside, I don't mean illegal inside. If you have some edge because you're in the industry and you understand what's going on there, that you can determine if you should be long or short, great. Otherwise, I wouldn't touch it.
Well, Rick, copper sometimes gets that energy metal vibe because of the AI data centers or the crypto mining or the EV and the renewables. If we need more solar and wind, we're going to need more copper. But another metal that falls in that same energy metals camp is uranium. It's had a bit of a bounce, and the uranium miners through the ETF URNM had a nice rip higher after a pretty bad sell-off the last couple months before that. Any thoughts on uranium or the uranium equities?
I give it a barely minor bullish tone. So if you go back since the COVID low in 2020, you have higher highs and higher lows. But I've also got some exhaustion signals in place from late first quarter, early second quarter this year, which actually coincided with the peak price for, I'm looking at the URA ETF, which is global ex uranium ETF. And so I could make the case that it's trading range. And if you buy strength or sell weakness, it's the wrong thing to do. You actually want to buy weakness and sell strength until that range changes. Right now, over the last few months, again, in the URA ETF, your lows are around 23, your highs are around 33, 34, and play the range until it decidedly breaks out from there.
Rick, what are some of your favorite commodities then? It sounds like even though you're selling gold, it still could go higher after somewhat of a correction. Do you have a favorite commodity that you see upside in?
I'm going to answer that question by saying I don't right now. I watch the big commodities consistent, like daily. but it's been a while since I got into the softs or the grains the way I was a year or two ago, where I was actively trading them through a fund, and that fund changed, pulled back from doing what they were doing. So I don't do that for them anymore. So I watch gold, silver pretty religiously. I watch crude oil and natural gas pretty religiously. Beyond that, well, okay, let's put copper in there too, but I don't spend a lot of time looking at the softs, the grains, the meats. So the answer is I don't have a favorite commodity right now because of the major ones I look at. Oil is stuck between occasionally some political, generally Middle East or OPEC related rally versus ample supplies. So it's trading range and doing nothing. Natural gas spiked up to almost $3 and then fell down to, I don't know, 2.25. It's doing nothing. At least it finally bounced off of its lows under $2. Gold I've commented on, silver I've commented on. So the answer is I don't really have a favorite commodity right now.
Well, how about this, Rick? In the energy space, the traditional oil versus nat gas, which one do you like more if you had to pick one?
It's funny. I actually have a position on in that I'm long USO versus short UNG. So I have picked oil over nat gas mostly because of potential flare-ups from the Mideast, giving the potential for oil to always, get that pop. But that trade I put on earlier in October, I'm up a little bit on it, but nothing special. And I'm not sure I'm even going to stick with it much longer. In fact, I'll tell you another thing. I'm in this game over 40 years. I am closing down most of my trading positions by November 4th. So going into election day, I don't want to have much on. I'll have certain pair trades on that are working, but outright trades, I have no idea how people are going to react to this election. We do have a little history with Trump running. So if you think back to November of 2015, when he ran against Hillary Clinton, election night when she was ahead, the Dow was down 1,000 points. But as the night went on, it started turning because Trump started edging her out. And by the close of business, the day after election day, whatever that Wednesday was, the market actually closed higher than where it had closed on Tuesday. So I could see something, similar to that happening now. If Harris is ahead, I could see them selling off stocks. If Trump's ahead, I could see them rallying stocks. And as that, election night goes on, depending upon how those numbers are swinging, I expect to see big swings. And I don't really want to have a lot to do with that because now you're dealing, you can do all the research you want, but when you're a trader and you're living somewhat in the shorter term realm of, days to weeks to a month or two of trying to figure out the next move, that makes sense to put on in a particular stock, ETF, commodity, whatever it is you're trading. You get events like this where we just don't know how the market's going to react other than we could say historically, okay, Democrats are not as good for the market, or at least initially thought to be as good for the market as a Republican could be. So maybe if Harris, is edging, or do the S&P sell off 50, 100 points? I don't know. But if, for trading positions, I don't think I want to get involved in that. So I will close down on most things and come into that day with only some pair trades on, and only if those pair trades are up enough that I feel like there's a cushion.
Wow, very interesting, Rick. I'm going to be following up with you after the election, so we'll see what the new positions are that you put in. Again, Rick Bensignor, president of Bensignor Investment Strategies. Click that link for the In the Know Trader website to check out Rick's retail products for all of you traders out there listening to the show. Rick, it's always great having you on this weekend show. Thank you very much for your time this weekend. I hope you have a great rest of your weekend.
Thanks for having me, guys. Look forward to our next time.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report, and now shifting the focus over to the energy sector as I'm chatting with Josef Schachter, founder and editor of the Schachter Energy Report. Also writes the Ion Energy Report, which is a free report more covering the macro data for the oil and natural gas sector. As a quick note, Josef is running a special discount for the annual membership of the Schachter Energy Report. This is the best offer of the year. It is $150 off the annual subscription. I'll post a link in the show notes so all of you can find out more of those details. Josef, I just got back from your energy conference. It happened last weekend on Saturday. I think it was my 4th or 5th year out there. I had a chance to sit down with a handful of some of the oil and natural gas companies that were exhibiting at the conference. I am releasing those interviews throughout last week and into next week. So again, thank you for putting on that conference. I know you're going to be doing it again next year, but let's just recap that conference. There were a lot of companies there. You gave a keynote speech to kick off the conference and hosted a natural gas panel at the end of the conference. Give us a bit of a rundown of what stood out to you, please.
Sure. The word of mouth is getting out that we have, really high quality companies, from the biggest being Tourmaline to some others like 2,000 BOEs a day like Southern Energy. So the word is getting out that we have, a lovely mix of companies on the E&P side, domestic, international service. We had one royalty trust company there, and the word has gotten out about the conference and of the quality of it, and the facility at MRU is fabulous. Last year, we had the Premier open the conference. This year, we were fortunate to have our Energy Minister, Brian Jean, open the conference. And then I did my macro speech, where we are on the energy supercycle, which had, full attendance in the Bella Hall at the MRU, Mount Royal University. And then at the end of the day, as you mentioned, we had an LNG panel, natural gas panel, and that was because we're having LNG Canada in the months ahead, bringing on the first west coast of Canada LNG export terminal, and that's going to take 1.9 to 2.1 BCF a day out of the Western Canadian Basin, which will be a nice shot in the arm to the natural gas producers. We had 40 companies presenting. We had over 700 attendees. That's up from 640 last year. Most of the rooms were full. We even had signage up when we were at capacity in a large number of those rooms. So it was a very, very productive day. We also had 6 companies from not only the energy industry of today, but of the energy industry of tomorrow, which is the TMX inviting companies in clean tech, renewable, and critical minerals. And we had a number of lithium companies, and we had one company in the uranium side. So that side of the program also was pretty good. So all in all, a very successful day. And, we have some good ideas, and we're talking to people about improvement. People love the food. They love the atmosphere. They love the parking. So all in all, very successful, and we plan to build on that for our 2025 program, which, once you finish this, you get a month or two off, and then in February, March, we start all over again.
Yeah, start planning for next year. It was fun to go to that conference, Josef. The one thing that I really like about the conference is the focus on companies. There is the speeches from you and some of the other special guests, but it is company focused. So let me ask you, any companies that stood out to you? Where should we be shifting our focus for oil and natural gas companies?
Well, if we look at companies that are Canadian domiciled, names like, Tourmaline, Surge, Obsidian, Yangera, Petrus, Saturn, on NuVista and Advantage were probably names to look at. And then on the names on the international, Valeura Energy, Gran Tierra, Touchstone kind of drew a lot of attention. And then on the service sector, Total Energy, Trican, Step, and McCoy Global kind of drew a lot of attention. So we were very fortunate to have some very good support from the industry, and the individual investors got some great access to great companies. And so depending upon what you want in your portfolio, the mix you want in your portfolio, we try to have a lot of bases covered with the companies we invite. And again, we were fortunate to have that this year. And again, next year we might be able to, with the spacing, maybe go up to 45 companies and maybe push the count up to 750 from 700. So, we'll be talking to you sometime in September of next year about letting your audience know. So if they want to come to the conference, they'll be able to do that.
So, Joseph, one thing that I was noticing with a lot of these companies, and it's been a trend from the last couple of years, is that it does seem like a lot of the oil companies, especially with the oil price fairly stable this year, really for the last kind of year and a half, it's been stuck in a range. These companies are making money. They are returning value to shareholders. But I think a lot of them are still looking for growth. They are reinvesting back into their land packages. What's something in your eyes that investors should be focused on that will help? Let's focus on oil companies here, separate themselves from the rest of the crowd, which again, they are still broadly doing well at these, let's say, $70 oil prices.
Yeah, remember $70 oil times the Canadian dollar, 1.38. That gets you a pretty healthy price. If you look at prices compared to last year, we're down about $10 Canadian versus last year. The big issue is natural gas, where we're down about $2 from last year. It was probably $2.75, and for the quarter it was probably $75. So it was pretty lousy Q3 of 2024. But again, once LNG Canada comes on, that should tighten up the spread, and we'll get better pricing that the industry can handle. So all in all, on the oil side, what I would be watching is you're going to have probably lower cash flows, but a lot of free cash flow will be generated. One, the companies are paying down debt. Once they're under 1x debt to cash flow, then a lot of them have said that they're going to go and spend 50% to 75% of that on a return to shareholders format. Some of it will be NCIB, some of it will be dividends, some only like NCIB, some only like dividends, and there's a lot of them in the middle that do both. So I think that you've got to decide what's important to your portfolio. Do you need income and capital gains, or do you want capital gains? And that's really the differentiator, using the NCIB or not. I like companies that do both. You get paid more than you get in the bank, 7-8% yields in many cases, and you have the growth opportunity in those that are focused only on NC. Then you're looking for higher commodity prices, but with the crude oil down this week, the stocks have been weakening. So, and I think we're going to see during this period between now and the end of the year, a lot of tax loss selling from mid-November to mid-December. And that's because energy stocks are down for the year for the most part. And if people made a lot of gains in technology and banking or other areas of the market, then of course the Canadian tax rates have gone up for capital gains. So you want to shelter it against your losers. And I think that from mid-November to mid-December, we're going to probably see a bit more pressure. And if we are below $68 WTI, I think we're going to see some fabulous bargains. And I think we'll be sending out another action alert buy with additional names and saying it's time now to go to whatever a fully invested position is for investors, to go and make the appropriate decisions to take yourself to that weighting, depending upon what you and your investment advisor recommend.
Let's talk about that debt component then. A lot of these companies have paid down debt. You mentioned that their goal is to get under 1x debt to cash flow. Well, it's a red flag if investors are looking at debt levels of companies. And what do you think is a healthy amount of debt for these companies to carry? Or simply, do you want to see them pay down pretty much all of their debt?
Well, no, I think debt is useful, especially if you're a high quality, high grade, and you can get debt with very little conditions on it. You don't have any secured debt. It's unsecured corporate debt and hopefully low interest rate. And that gives you some firepower to make acquisitions, to do other things. And, you see companies doing that. CNQ, with the purchase they just did from Chevron. We see that with Tourmaline buying Crew. So there's a lot of different ways for companies to use debt appropriately. But if you're over 1.5x debt to cash flow at these reduced cash flows because of the low natural gas price and the lower oil price, then you've got to focus on getting debt down and forget about shareholder returns. But once you are in that comfortable zone of under 1 time, then you can look at options for a near-term return to shareholders. And then the more important thing is continue to have a leg for growth. I like companies that have a growth leg and that you can see where the trajectory between now and the end of the decade is for a 30 to 50% bump up in volumes. And if you can see that from the facilities, from the inventory of drilling locations, that's where I would target my investment recommendations, is to go for the companies that, depending upon if price is there, that they have the ability to grow materially.
Hey, I'm with you. A lot of investors like that growth component, but then how do you balance that out with dividends and those NCIBs, the share buybacks? A lot of the companies return capital to shareholders, but they also need to use that capital to put it back in the ground for growth. So what sort of ratio and balance do you like to see?
Well, I think once you're under 1 time, I'd like them to spend about a third of the balance sheet of the free funds flow growing the company, anywhere between 5 to 8% compounded annually. Some years it may be much less, some years it may be more, but a 5 to 8% compound growth into the end of the decade. Which means you've got to build the facilities, the gathering systems, all the infrastructure that needs to be in place has to be put in place. And then, of course, when you build a new facility, you want to fill it up as quickly as possible for the operating cost advantages. So that's really the issue there. I like companies when they're in good financial shape, paying dividend at least equal to what you can get in the bank and your, in T-bills. And the upside, if they want to pay a higher dividend, that kind of gives you stability on the downside of the stock, especially if you're paying a well-secured 7 or 8% dividend yield. You don't really have that much downside in the stock, if you have that protection.
Let's talk about the divergence between the large companies to the small companies. It's something we are seeing in a lot of resource sectors and really across the markets, but the large oil producers, in my eyes, still seem to be doing quite well. The smaller ones that maybe have more of a growth component to them, they are still broadly lagging. It's something I continue to hear from some of those smaller companies, maybe sub $500 million, even a couple $100 million. They're saying they're just not getting the market love out there, but they said that they're following through on a lot of their initiatives. Do you see opportunity in these smaller companies, or is the play here to stick with the big guys, take those dividends and take that slow and steady growth?
Well, historically, that's what happens in the cycle is the big money that wants to be in the biggest liquid names. So between the Americans wanting Suncor and CNQ and Cenovus, and then Tourmaline and Paramount, and then as more and more investors get more comfortable, then they start going down in size. And that's just normal part of the cycle. But if you look at the upside of the big names and you put the same cash flow multiple on the smaller names, you've got doubles and triples in front of you. So when people start going down in size to see the faster growth, the fact that there's a massive discrepancy in valuation, then you see a big bounce up in the companies. And I think that's what you're going to see in 2025, 26, where there's going to be a big catch up from these small and medium-sized companies because of the big discrepancy between the valuations being paid on the big boys by large investors on both sides of the border.
We talk a lot about this in the metals sector as well, and the question always is, what will make those investors go further down the food chain and try to take advantage of that discrepancy, that price discrepancy? Is it commodity price base in your eyes? Is it oil and natural gas continuing to move higher? Or what other factors could draw that money to filter down?
Well, I think it's as investors and the large caps get comfortable with the sector and we get over $90 WTI, which I see happening in the second half of 2025 on a consistent basis. And then heading into 2026, I think we'll see spikes over 100. When that happens, they'll be looking for the torque. Where is the big upside in terms of cash flows? And all of a sudden they'll say, my God, these little, smaller medium companies are trading under 2 times cash flow with significantly improved balance sheets and strong balance sheets in many cases, some paying decent dividends. and then all of a sudden they'll go down in terms of market cap, and then individual investors will jump on the board, and people will start talking about exploration plays and these new wells coming on with big numbers, and all of a sudden once you get into that exploration focus, the juniors start really outperforming because they have the ability on just a few wells on one pad with 2, 3, 4, 5 wells to really change their production schedule, and that wakes the street up and investors jump on board, and then you see big runs. And we saw that in 1999 to 08, 2000, 2001 was big cap, and then 2002, 3 we started seeing the move into the smaller cap, and then by 2008 all of them were running as we went to 147, which was the summer of 2008 at the high. So, the front money is usually into the big caps. Then as all of a sudden prices, are not seen to be short term, but they're consistently at a decent price and heading north, that's when people start jumping and going down market. And that's when we see these big runs. And, if you pull out most of the stock charts of any company that was in existence in 2000 to 2008 or 99 to 08, you'll see 10 baggers, 20 baggers. And I think that between now and the end of this decade, I see 5 and 10 baggers in a lot of places. And that's just assuming going from under 2 times cash flow to 8 or 9 times cash flow, going from PDP, proved developed producing reserves, to 2P valuation reserves. And then, of course, you add in the price increase in the commodity, which adds to cash flow and NAV. And then you add in volume growth, which also adds to cash flow and NAV. And you could be talking 5 baggers. And I look across the universe where we cover, and on the small and medium-sized companies, I see a lot of them that fit that bill.
Yeah, that rising commodity price also really helps that filter down of money. Let's talk about the underlying prices then, because oil, as I said, still at a reasonably healthy price, but quite frankly, the price has done nothing. It's been broadly stuck between, let's just round it off to about $70 to just over $80 a barrel outside of a couple price spikes. And it's been in that range through almost all of 2023 and 2024 now. Again, there's been a couple price spikes and price drops, but this has been a stable environment. One thing I continue to hear, though, is lower demand. Is this just seasonal in your eyes, Joseph, or is this a trend we need to understand that there just isn't that screaming demand that we have seen in the oil sector?
Well, historically, when you have a sluggish economy in the biggest consuming markets, like the United States is the biggest, and then China number 2, China's down 300,000 barrels a day of consumption from last year. The U.S. is flat versus last year, 20.2 million versus 20.17. So very similar numbers. This week we had a decline of 446,000 to 20.25 from 20.7 the week before. And there was a build in inventories of 5.5 million in commercial reserves, and total stocks are up 6.7. So we had increases in storage, lower demand, and that's why we're down $1 today in the price of crude. So I think that between now and the start of winter, I think we have a couple, with tax loss selling and maybe prices coming down below 70 again, I think below 68 even. I think that will give us a low risk entry point, and we'll probably send out another action alert buy to our subscribers saying, look, the price of oil is down at bargain levels. Stocks have retreated because of tax loss selling. This is a great buying opportunity. We'll probably add additional new buy recommendations, and then we'll reiterate, going to our buy list and looking what fits your portfolio. But I think that this will be the buy signal where we have not said go to fully invested in a couple of years. We'll probably be saying that again. March, April 2020 was the last time we did that. And then we got into 21 and stocks really had run big. We suggested harvesting. So right now, I think this is going to be the next window coming up here in the coming weeks and into mid-December, where we say it's time now to get to whatever is appropriate for you. Sit down with your investment advisor. What risk profile do you need? Dividend income? Do you want to buy utilities? Do you want to buy growth stories? Whatever is appropriate, service, etc., domestic, international, and take whatever that is and take it to a fully weighting for whatever is appropriate for each individual.
So is the oil sector on the downside in your eyes, potentially susceptible to a longer term or more sustainable breakdown as either economies struggle around the world or focus switches more to the natural gas market and money rotates more in that direction?
Look, if there's a market correction of 15 to 20%, and we're having a big down day today in the general market, and it's related to some earnings disappointments and rising interest rates, the U.S. yields have gone up sharply over the last month. So people are worried about inflation and a debt overhang where there's a crowding out effect. So we're seeing the rising interest rates, weak earnings, which are not good for the stock market. If that continues, we're going to probably see a drag on the energy sector, and that will give us the buying opportunity. And so I think this is just a short-term phenomenon. I don't think we go much below 70 for very long. It usually spikes down because of hedge funds shorting and bad news on the EIA data or China data. But I think once we get into winter 2024-25, I think we're going to see improvements year over year. China's trying to pull out more and more stimulus to get their economy going. And again, once you get past this election, I think the uncertainty will be removed and we'll start seeing U.S. demand start picking up as well, depending upon which candidate and what they're supporting. They'll tell you should go for oil or gas or whatever. But I think the energy sector, because we're going to need more electricity, data centers and the whole infrastructure of electricity needs to be a lot of money spent on it. So copper will be in big demand, and we'll need to expand potentially 50% or double the amount of electricity that's produced, and renewables can't do it on their own, that we're going to see more demand for cogen, especially natural gas, in a Democratic victory. And if it's a Republican victory, oil will see a much higher demand bounce simply because the industry will be told, drill and let's be an exporting powerhouse, because we do have the basins to bring on more production in the years ahead.
So when it comes to natural gas, then look, everyone's focused on these LNG terminals. They are progressing. Yes, some have been delayed, but there are some of these coming online in the very near term. So what I kept hearing at the conference too is, look at these terminals. This is going to cause price spikes. This is going to change the whole oversupply narrative that we hear in North America. Joseph, is that going to have the price spike that you think some of these companies and commentators are pointing to? And are there any other catalysts out there for natural gas outside of these LNG terminals?
Well, I think that I wouldn't call it a price spike. I'd say a price recovery, because the industry needs $2 to $3 US or Canadian to be economic. And if you get cold weather, you get spikes to $4 or $5, $6 in bad weather when you have big draws because of that cold weather. But if we can get a consistent price of $2.5, $3.5 between now and the end of the decade, that would be very economic to the industry. And remember, it's not just the LNG. We'll have one new Canadian facility, LNG Canada. We're going to have announcements of more when they do FID. LNG Canada could go to train 2 and announce it. And then you've got a couple of new facilities coming on in the U.S. So that's going to increase exports. But as well, as I mentioned in our previous commentary, is that the demand for electricity is growing. So you're going to, for data centers and whatever, so the natural gas is going to be needed for cogen to create electricity. That's going to be a big incremental. And then, also the products that are created, the whole chemical product chain where you have as a feedstock, oil, all of that is going to see demand increases into the end of the decade.
All right. So then, Joseph, right now, I guess, waiting for another buy signal. Are you going to be more focused on natural gas than oil, or is it going to come back to those oil companies, or even better, a company that has more blend of both?
I think you want to be in both oil focused and natural gas focused, and that's what we've been doing with our portfolios. Also, we like the service sector, so we have names there. And we also like both international and domestic. We did a poll at the conference where we said, how many people own 3 or less? How many own 4 to 7 names? How many people own 8 or more? and the majority of the people owned in the higher numbers. So people are adding more and more names, adding diversification. And at the conference, they went to see the companies they owned, and they went to see companies that they were interested in. So I think that, as people get more and more comfortable with the sector, because we're in an energy super cycle, we've only had two in my career before, 1974 to 81. Price of oil went from under $3 to 36. And then, of course, Volcker decided to slam down and beat up inflation. 99 to 08, we had a massive cycle because China went from, communism-controlled economy to communism political power, but capitalism for the economy. And the demand really took off on energy. And the price of crude went from, under $11 to $147 in the summer of 2008. This cycle, we were at $650 in March of 2020. And this super cycle is going to be by the emerging world, bringing on copper, nickel, lithium, all the raw materials we're going to need for the new, world of renewables. And so if we want EVs, we want batteries, for battery technology, you want solar panels on homes, you want to do all the things that are going to be more climate friendly. That's going to require a lot of money being spent in the emerging world to bring on the raw materials, and that I think is the driving force for the growth. If in our forecast that we showed at the conference, we see demand in the OECD coming down between now and the end of the decade, but we see much more growth in the non-OECD, bringing the demand from, let's say 102 million barrels a day daily consumption on average in 2024 to potentially 108 million barrels a day by the end of the decade. And the industry is not spending enough money to bring that growth that's needed, at this point. So we need higher prices to incentivize the industry to spend and bring on that increased production that's going to be needed before the end of the decade.
That is true. We need that growth, right? That's always what draws in investors. And quite frankly, that's what grows a sector. And that's what investors are looking for. Josef, it's always a pleasure chatting with you again. Josef Schachter, founder and editor of the Schachter Energy Report. Click that link in the show notes to take advantage of Josef's best offer of the year on an annual membership for $150 off. And please, everyone, be sure to go back through our website, kereport.com, and podcast. Search the KE Report in your podcast player to listen to all the daily editorials, company updates, and some of the company interviews that I recorded at Josef's recent Catch the Energy conference. Josef, thank you for your time on this weekend show, everyone. Thanks for tuning in. We'll be back with you next week.
Thanks.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.